Good evening, everybody, and a warm welcome to you all. Thank you for coming and gracing us with your presence for the Allcargo Logistics Limited Analyst Meet for Q2 FY19. On behalf of the company, I would like to thank you all for participating. Before we begin, as is mandatory, I would like to mention a short cautionary statement. So here we go. Some of the statements made in today's analyst meet may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties, which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audiences are cautioned not to place undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's analyst meet is purely to educate and bring awareness about the company's fundamental business as well as provide a quarterly review. Before we begin, I would like to introduce you to the management that is participating with us in the dais today. We have with us the chairman, Mr. Sashikiran Shetty. Mr. Shetty has been a pioneer in the Indian logistics sector for more than 3 decades. He has founded and steered Allcargo through several milestones, making it the global leader in LCL consolidation and the largest Indian company in this space to provide end-to-end logistics services. Having the foresight to invest in technology and build a sustainable organization, Mr. Shetty is leading several internal change management campaigns. We have with us Mr. Adarsh Hegde, the Joint Managing Director. Mr. Hegde has been associated with Allcargo Logistics since its inception. Under his leadership, Allcargo established multiple CFS and ICD facilities pan-India, along with projects and engineering divisions as well. He has helped the group foster strong relationships with major liners and other global partners. As the president of the Container Freight Station Association in India, he is highly acclaimed for his knowledge about the sector. We also have the privilege of having Mr. Claudio Scandella, CEO of EQ Worldwide. Mr. Scandella is a veteran in the logistics industry with over 35 years of experience in the international freight forwarding business. He comes with us experience of scaling up and transforming businesses. Mr. Surya Narayan is the Group Chief Strategy and Financial Officer. A chartered accountant, Mr. Suri has also closed 35 years of work experience in diversified businesses like engineering, petrochemicals, shipping and logistics. He had led the company through a series of project implementations and M&As. He has been involved in transforming the group as a global leader. Mr. Prakash Tulsiani is the Executive Director and CEO of the CFS and ICD division. Mr. Tulsiani has over 2 decades of experience in the business of shipping and ports, both in India and overseas. He's a qualified chartered accountant and company secretary with expertise in scaling businesses and turning them around. Now, I would like to briefly give you a small overview on the company, after which I'd request the management to give their presentation. Allcargo Logistics Limited, which was incorporated in 1993 by Mr. Sashikiran Shetty, is the only integrated multinational private sector logistics company engaged in providing end-to-end logistics solutions in 4 major segments, which are Multimodal Transport Operations, MTO, CFS and ICD, Project and Engineering Solutions, and Contract Logistics. It is a well-capitalized and diversified company with a strong network of over 300 offices in more than 160 countries. The company has a strong management team and experienced industry professionals and a global workforce of over 4,500 employees. Allcargo is the global leader in the less than container load or LCL consolidation segment of the multimodal logistics, and also one of the only CFS players in India with the widest network of CFS ICD operations with presence in the key ports of India that handle over 80% of the total container traffic in India. Now, without much ado, I request Mr. Sashikiran Shetty to take over for the presentation. Thank you, and over to you, sir.
Once again, ladies and gentlemen, a warm welcome to all of you, and I really thank you for your overwhelming participation in this analyst meet, which we are holding now after about 3 years, or 3 to 4 years. The last one was at the St. Regis. I still remember that. They well participated even those days in that event. I would like to take you all through the key global trends which impacts our business. And then I'll have my colleagues take you through some of the businesses. Adarsh Hegde will take you through the India business, how it is looking, the performance, etc. And Mr. Scandella will talk about EQ Worldwide. and Mr. Suri will present the financial performance of the company in the last few years, and Prakash will put give his inputs on a need basis. So talking about the global shipping industry and the current trends. As all of you know, the economic growth in the United States, China, India, and other emerging markets have helped the world trade to grow in the last few years, with of course some bumpy rides about financial crisis and India crisis, etc., etc. There have always been back and forth on that area. However, I think the global trade kept on growing due to consumption and what have you. World seaborne trade is projected to further expand at about CAGR of 4% in the coming years. Trade growth, as far as the container shipping industry is concerned, the trade growth looks like going to outpace the container fleet growth. So that's a good news, but as all of us know, there are other factors that might change the situation. I'll talk about that a little later. Keeping this in mind, the average freight rates on the major trade lanes have remained stable in the last couple of quarters. And also the lot of measures that have been taken by the global shipping industry over the last couple of years have helped the rates to stabilize to some extent, although they try to increase the rates in every opportunity that they get, but they don't really, they announce a big GRI, but eventually the rate do go up, but they come back to certain levels and stabilize over there. And overall, there is some marginal increase, and they keep bringing up these GRIs. And overall, the rates are fluctuating, but they are settling at a level which is quite reasonable, at least in the last few quarters. As reported by Maersk last week, the trade restrictions and the trade war that is happening between United States and China, and also the Brexit factor, the container trade actually might go down by 0.5 to 2% in the short term. So this is a warning that is issued by Maersk. We will all know more about it in the first week of January, when the tariff is going to come into implementation, to see how the whole situation will emerge. However, as all of you know, that the container shipping industry has been in the consolidation mode because of very high impact of excess capacity that has been built over the last few years, primarily because the countries like China, South Korea, and Japan governments have promoted shipbuilding at a lower and lower cost to attract the shipping companies to buy more and more ships. And the shipping companies have become prey to that and bought so many ships and got themselves into greater difficulty. In the process, quite a few of them could not stay healthy, and they had to sell out. As all of you know, that one of the most prominent shipping line called Hanjin Shipping went bankrupt, and that had a profound impact on the container trade, and that then forced many of the other companies, some medium-sized companies, to sell their companies to their major competitors. So the consolidation, substantial consolidation has happened, and also closer collaboration between biggest competitors in the world, like Maersk and MSC, could never imagine that they could ever work together, and that forced much closer alliances between the global carriers. So actually, if you go to see, about 5 large carriers are now carrying almost about 75% of the global trade. So consolidation is really has come to stay. And also, interestingly, with this situation, a lot of the major shipping lines and some of the port operators are becoming also moving into land side and restructuring their freight forwarding, supply chain organizations into the main organization, thereby trying to offer more door-to-door services and accessing direct shippers and the consignees for their services. So this is another major change that has happened due to the consolidation of the industry and how technology is also driving such a move by the global carriers. Talking about the Indian logistics sector, as per the ICRA report, Indian logistics sector is poised to grow from $160 billion in FY17 to $215 upwards in FY20. So a 10% CAGR growth. India aims to reduce its logistic cost to less than 10%. There are different figures floating around, but we in the shipping industry very strongly believe that the logistic cost is not more than about 12 to 13%. Although government sometimes claims that it's about 15 to 16%. The reason I'm saying this is because we operate globally and we don't see India is doing so badly. India is a very efficient logistic market. The freight rates are comparable to the world markets, and except the infrastructure and certain amount of ease of doing business has also been now done by the government. So I would say Indian logistic market is competitive and comparable to the developed economies in the world. Now that the infrastructure status has been given to the logistic and warehousing sector, so that should help in fundraising and making your entire funding cost lower. Very interestingly, as all of you know, that the Make in India program and a big focus on the government to increase local manufacturing in India, one for export and also for the growing consumption of India. India want to be at 25% of the GDP coming from manufacturing. And that obviously is also going to create a lot of jobs. So, and also the fact that there's a huge target for the export to grow to about $900 billion from the current $350 billion going forward by within the next 5 years. That is the target by the Ministry of Commerce. We'll have to wait and see whether that is achievable. I think with what's happening in the global trade war, it looks like quite a bit of manufacturing which is likely to move from China into Southeast Asia, and India is one of the destinations where the manufacturing is likely to move, including the Chinese companies are looking at investing in India for their own manufacture so they can compete with the new trade regime that is going to come into effect. As all of us know, GST is now a big success. One India, one market, one tax, and that is clearly going to help the logistic industry in the country. The consumption-led growth in e-commerce is driving specialized logistic services, and our company is taking strides to participate in that. As all of you know that we have now forayed into Indian domestic market using ACCI as one of our prime vehicle, and we also have plans to spread our operations in the growing Indian logistic market going forward. There is a big demand for A-grade warehouses due to consolidation of the inventory by most of the manufacturing and also by the e-commerce, and also conversion of B and C grade warehouses, demand moving into A-grade warehouses. So that is one area for the logistics sector to look at, and the company is clearly looking at that. I already spoken about the manufacturing investment that is going to come into India in the near future because of the export growth and also because of the trade war. Industries are likely to expand the manufacturing. So this is somewhat the macro picture, and I'll come back and speak about the future of the company in terms of way forward. I'll come back to that later. And now I hand over to my colleague Adarsh Hegde to take you through the CFS, ICD, and project and equipment business and the contract logistics business.
Thank you.
Thank you, Adarsh.
Thank you. Well, most of you, can you hear me? Most of you all, you'll know that we are one of those largest CFS operators with the state-of-art facilities in JNPT, Mundra, Chennai, and now in Kolkata as well, which covers almost 80% of the Indian container traffic, if I had to put it. We do have an installed capacity of roughly about 500,000, and it did make an impact into the CFS businesses. While I must say that this was these inefficiencies in the system which has been removed, while the business model has changed, and we have achieved targets in spite of these changed business scenarios. So I would say that direct port delivery has not really impacted. It did impact for a smaller period of time. That was like a lag for about 4 to 5 months of time. And then since then we have actually changed our business model while increasing our customer base to deeper penetration and business excellence. No major capex is envisaged for now, at least in these existing locations. And must tell you, with these impacts, I guess there could be a lot of industry consolidation that could also happen. In the CFS business, I just want to put this across to you all that the ports are not designed to take containers within the port. These are all done internationally. While our ports, when they were designed, the container freight station was not taken into consideration. One is the big part of this, the labor part of it, which becomes a bigger challenge, and hence they had kept this out. So the container freight station business is here to stay, and it will continue to be there. ICDs, for sure, you all know it's a landlocked area where we want to service, so that will obviously continue. So if somebody has this in mind, saying that it will continue, that the containers will get into the port, that's not going to happen. These ports are not designed. So the point that I just wanted to share with you all is that, yes, this was something that was, people questioned us, all of us, that, hey, is the DPD going to, I mean, is the CFS business going to be there? No, it's going to continue in India, at least. That's the scenario. While you would have seen our volumes, those are the volumes which justify that the number of TUs that has increased on a quarter-to-quarter basis. Our volumes have gone up, quarterly revenues have gone up, and if you look at the annual revenues as well, in terms of our percentage, EBITDA margins have also gone up from where we were. The highest that we had was probably 31 in FY16. We are back to that EBITDA margins in this quarter, this half-yearly results. And I see that this is going to continue to be there. Our return on capital employed, if you look at it, which was around 27-25%, is now to 34%. Import and export mix continues to be the same, I would say. We were around 75, between 25, 30 is the exports, that we continue to be there. Well, the insights, expected change in DPD policy, as I just told you all, shall bring in more stability to this business. With port-related CFSs well covered by us as Allcargo, we have a possible foray into the rail-linked inland depots, though we have a container freight ICD in Dadri. We have more opportunities. Developing opportunities to handle high-value cargo and ancillary services to provide integrated logistics solution. What I mean by is that we are thinking ahead so that we don't want to be left out, where we can bring in those value-added services to our existing customers and the new customers as well. We do enjoy a long-term relationship with most of the leading global carriers, though the volumes would have not been that great in the port, but if you look at our volume growth has steadily increased, much better than the rest of the competition. This is also due to the synergy that we have on the global MTO. While we get to the projects and engineering solution, this business, this has been a business that I'm sure people have been talking about. Just to bring you on page, logistic solutions for complex and critical loads. This does that. We do service a lot of Power sectors, we service oil and gas, refineries, cement, steel, ports, and infrastructure. With the markets turning around and with an increased momentum in infrastructure projects, this vertical will be a value generator. I can tell you this. While there, because of the GST rollout, there was a little of a ambiguity in the taxations. So a lot of projects got stalled, which did affect us. Asset utilization did go down. And obviously, any of the project implementer would not like to go ahead with this project if there is no visibility, if he doesn't have clarity on the taxation part of it. While that has now, is a bygones now, I would say, there's a lot more visibility, there's no more clarity now, a lot of clarity, and that has actually seen in our business as well. If you look at it to the next one, our utilization, which was around 45% in the last quarter, is already moving towards 65% as we talk this quarter. So it's a momentum that has started taking, and I guess, as I said, this could be a value change for us, and this is going to bring in a lot of value to this organization. While you look at it also that year on year, I guess from 700 to 900, that's roughly about 30%. 34% quarterly revenues. That's year on year if you look at it, which is again a sign of saying that there is a lot of improvement that's happening on it. Quarter on quarter, the growth has also been 30%. The growth in the infrastructure sector, as I said, especially in the power, oil and gas, cement and steel, is expected to increase demand for specialized transportation solution. A strong order book in the project transportation of over 175 crores, which is going to be executed during in the next 10 to 15 months. As I said, our asset utilization in the equipment vertical is already up to 65% from about 45% in the last few quarters. While the order book for the equipment business is also close to about 75 crores, and we have a lot in the pipeline as well, I would say. There will be a lot of focus on improving margins. We did also got out of some of our assets which were not, which were underutilized and age barrier as well, because we didn't want to be with those old equipments. But I must also emphasize here that people talk about depreciation in the equipment, while today we were able to sell those equipments 150% of our book value. This is just for your information. So, while we look at it saying that, your value of that asset must have gone down, but while we sell, actually, the market value is very different than what the book value of the asset is. Replacement value of current cranes on the books as of date would be approximately at the same levels. Now, coming to the interesting one, the supply chain management. Allcargo is one of the predominant players in the supply chain management segment through its majority equity shareholding, as the chairman shared in our share CCI. That's the brand that we have got. We are in most of the places. If you look at the map on your screens, we are in Delhi, Gurgaon, Jaipur, Ahmedabad, Baroda, Nagpur, Mumbai, Hyderabad, Vijayawada, Bangalore. We've almost covered most of the places across India. Presently, we are with about 3.5 million square feet of warehousing space that we manage, which is client inside the client premises as well, and external on an asset-light model as well. We have 45 warehouses, as I said, 45 warehouses locations across India. And just to tell you that we are 97% is the utilization percentage of these warehouses. All these facilities are state-of-art, that are scalable and customized. With a strong IT infrastructure, you will all agree that this business needs a lot of IT infrastructure, and we continuously keep investing in these new generation IT requirements as well. We are geared to meet huge demand driven by the stabilization of GST and e-commerce. The Insights CRISIL report has estimated that the supply chain management is expected to grow at a CAGR of 19 to 21% to reach INR 57,000 crore by 2020. Huge opportunity for all of us. In fact, Allcargo is in a great position to take advantage of this. We have plans to scale up this business with a top line target of INR 1,000 CR, along with the increase in the warehouse space to 10 million, as I said, from 3.7 to 10 million square feet in the next 5 years. Targeted segments, we are in chemical, we are in auto, e-commerce, retail, and fashion. We develop build-to-suit model warehouses where technology and automated process will play a major role. We are also exploring opportunities to expand globally. I wouldn't say that we are exploring, I would say that we are already in. We have already embarked on this, and we have already started a facility in Kenya and Dubai, and we see a lot more opportunities coming our way with the existing Indian customers that we already handle in India. We're developing an asset-light distribution model by partnering with various established transport vendors, because transport is also going to be a key in this business going forward. Thank you. My colleague Claudio will take over the multimodal transport operations part of it.
Thank you very much, Adarsh. So I'm happy to address you today in regards to our multimodal transport operation business, which, as you know, internationally brands under EQ Worldwide. As you probably are aware, that includes NVOCC services, which stands for Non-Vessel Operating Common Carrier Services, and that in our case is LCL, less than container load. So in other words, smaller shipments consolidated into a container from different customers, obviously, and the full container load business. We have those activities, as I mentioned already, across the world. Of course, India is included in that. It's a very important part of our business, but we also have a very global operation. We are covering the majority of world trade with our capabilities, and we have around, as you see here, we have around 300 offices across the world. The good thing about our customer base is that it is very diversified. We do have nearly 30% what we call global customers, so those are the biggest freight forwarders, which are well known to you, the DHLs, the Kühne-Nagels of the world, the leaders in ocean freight, and so on. But we have a significant amount also of small and medium customers, which is very important for us because it helps us to also assure that our yields are stable and on a good level. We have, as I mentioned already, we have 300 plus offices, and that is globally present. That means globally present in 160 countries worldwide. That is a significant network, a network which we can leverage going forward, because, you know, whatever world trade performs, wherever world trade happens, whatever happens, we are present and we can cater to the needs of our customers. Mr. Shetty, our chairman, has previously alluded also about the developments between China and the US. Of course, we hope that this will ease out going forward, but I think it's important to mention that we are in a very good position to cater for any growth which happens in other countries through a shift of trade. Of course, as I said, it's important for us to see that world trade is continuing to grow, and we have seen the outlook that world trade may indeed be affected by this. But should there be a shift away from China into other countries, India or Southeast Asia, we are well positioned to take advantage of that as well, contrary to some of our competitors which are operating more locally. The network I've alluded to, our business obviously is port to port, but we are connecting more and more hinterland offices also. This is a conscious strategy which we are also aiming at, because of course, you know, the port to port part is usually very transparent and will be more transparent in the future with the digital solutions coming in. So we are also diversifying more and more into hinterland movements, right? So we have just recently rolled out a digital tool, a front-end customer portal, which basically allows us to sell a door-to-door service to our customer. The port pairs which we are covering, as I said, are globally catering for the majority of the world trade. We are consistently growing the frequency now, since we have already weekly departures in most of those lanes. We are also looking at expanding with the volume growth, which you will see, which is happening on our side, also the frequency of the departures. That is quite important because, of course, supply chains are requiring smaller shipments. They are requiring regular departures, so that is a diversifying factor to some of our competitors, which may only have weekly departures in those cases. In the last couple of years, we have very much also diversified into full container loads. As you probably know, EQ Worldwide was traditionally an LCL provider, market leader in that segment. But the growth, a lot of the growth also which comes now into our books is coming from the FCL side. That was a conscious decision which the management took already a couple of years back, and that supports the continuous growth of our volumes. Volume is still a very important factor in our business, not only LCL, where scale obviously adds up to your bottom line. The better your utilization, the better you scale, the more profitable you can run your business, more cost effective, and therefore more attractive in the marketplace. On the FCL side, of course, we could leverage our global reach in LCL, where we had already significant volumes through our consolidated containers, which we could, of course, offer to our carriers. And with the growth, and that supported the growth in FCL. So we have today excellent relationships with most of the global carriers, and that relationship, that buying, that purchasing, that procurement function is very important, because obviously the market is well looked after by our competitors as well. So it's very important that we can leverage those volumes. Looking at some key figures, you see on the left-hand side, you see the volume development. On the upper side, you see it quarterly, and on the lower side, it's the annual development. Both show a very good trend, as I've already alluded to. The number of TEUs, 20-foot equivalent units, that is a measure which we use to track our volume development, has very nicely developed. Yeah? And that obviously through organic growth as well as through some acquisitions. On a quarterly basis, you can see that the revenue is also following track. Revenue in our business is to a certain extent, to a large extent, determined by the rate levels of the container carriers. Those are market rates. They move up, they move down. We have to make sure that the margin we get as a benefit out of this remains healthy. But the revenues as such are just one indicator to show the growth. As you know, the rates have been under heavy pressure in the last couple of years, with certain exceptions. There is no real change in sight of this. The overcapacity, which the chairman has also alluded to on the carrier side, is continue to be there for a couple of years. And that will be impacted obviously by the world trade. So if the world trade is indeed shrinking, that overcapacity will even increase. The outlook so far is that the overcapacity will stay for the years to come. So we do not expect significant changes driven by that ratio versus capacity and global volumes in the near future. However, there are certain changes on the horizon. You may have heard of a new regulation which comes into play in 2020, the low sulfur regulation, and that is a challenge for a lot of the carriers, because all the vessels have to be either upgraded or scrapped, depending on the decision. So that may well have an impact on on the capacity, but certainly it will have an impact on the cost because the different kind of fuel will have a more significant cost, and even the upgrading of the ships will cost money. So obviously it's to be seen what it does on the rate side, but as I said before, we have a well-established procurement team, and we should be able also here to move well with the market and leverage our global position and global volumes. You see also the annual revenues, which basically confirm the previous statement as well. What is nice to see is that our EBIT margin is continuously increasing. As you know, we are not in a high margin business. We have a low asset business. The return on capital is therefore very attractive, but the margin has to be one of the very important factors for us to continue to drive the scale, to continue to take advantage of our cost leadership, and to continue to expand on that side. Of course, it's also important for us to leverage the market, to be very close to our customers. As I mentioned before, we have implemented a digital solution. This is still being rolled out, but the capabilities which we have with that solution is obviously not only to attract a different market, but it's also an opportunity for us to improve our cost position, because data flows are easier to handle than calls from customers. So we are actively promoting that. So we are expecting a benefit from that going forward. From a geographic point of view, the graph which you see here on the lower right side is the billed revenue in the region. So it's as you know, in our business, either the freight can be billed at origin or destination. So it's not a very 100% accurate distribution of our regional positions, but at least it gives an indication. Asia, as you see, is very, very important for us. We have, in the last couple of years, been very successful also to consolidate our position in Asia, also with taking part in the intra-Asia trade. As you know, globally, intra-Asia is the largest container freight trade worldwide, bigger than the Trans-Pacific. And that also shows that we are not so much dependent on the trade between China and the US. It is an important trade, and we hope that the volumes are going to continue to increase. But we are well diversified globally, also with movements between Asia and Europe, between North America, Caribbean, Latin America, between Asia and Asia, between Asia and Africa, and so on, so that we are, I think, as I mentioned before, in a good position. Some MTO insights. As you probably know, we are in a fragmented market. There are a lot of local competitors, and for us, we look at this as an opportunity for growth, because with our global position, our global network, our capabilities, our know-how, our tools, we will be able to grow, and we want to actively participate, obviously, in that growth and in the consolidation of the LCL industry. We also continue to focus strategically on the expansion of our FCL business. We have been extremely, I would say, successful with that in the past, and it's our strategic target to continue to grow also on the FCL side. And I think the two products, they have very nice synergies on the procurement side and partially also on the operation side. We are an expert in ocean freight, and both those products are ocean-related products. We have customers, especially the small and medium accounts, which now also work on the FCL side with us, because of our volume position, we can offer them benefits. But in FCL, other than in LCL, where we are mainly catering to the freight forwarding market, we will also be able to handle more direct customers, what we call retail customers on the LCL side. An important thing which I already mentioned is technology for us. Digital is on our minds every day. We have different initiatives internally, and as you know, I've joined only 1 year ago. I'm very happy to see that the management for a while already has prioritized this as an area for development for our business. We have a significant internal program to put all of our entities on the same operating platform, which once achieved, and we are expecting this to happen in the first quarter of next year, will provide ability for us to leverage synergies from a global system base, right? So that also obviously will impact the quality of the service because, as you know, in our business, visibility is a key for our customers. They want to know where the shipments are. They want to have real-time visibility. And obviously, a global platform will enable us to also improve our visibility and the quality of our service. It is to be noted that we look at ourselves as a quality leader, right? And that is also the feedback which I already get from the customer base. So we really want to diversify. We want to differentiate through value proposition in the market. And with that change on the system side, we will be able to continue to improve our quality as required by our customers. On the other hand, of course, the external side, I've mentioned to you already the platform which we have launched earlier this year, and we are obviously tracking the market. We have looked at a lot of different digital platforms, which, as you well know, are also very much promoted. We believe that our systems are very much able to provide value in the market for us going forward. And we're not complacent. We will continue to work, obviously, to develop those solutions further, which will enable us, as I said, to improve our cost position per transaction, will enable us to get into into other customer segments, market segments, and will enable us also to continue to increase our quality. Thank you very much, and I hand over to our CFO, Suri.
Thank you, Claudio. Good evening to all of you. I'll quickly take you through our financial highlights. The key point that I would like to stress is we have continuously grown over the last 4 quarters in all the parameters in terms of our operational revenues, our EBITDA margins, our PAT, and our cash profit. So this is what I would like to stress upon, that in spite of an asset utilization that was low in the last quarter with around 45%, and currently, as others said, we are operating at about 60%, I think in spite of all of that, we have still grown from where we are. And I think the worst is behind us because the last 2-3 quarters were tough ones. We have turned it around, and I think we will see movement going ahead. And if you look at the next slide, in our operational revenues in the half year itself, and if you see between what we have achieved the previous year and where we are at the half year end, and even at the current run rate, we should exceed what we have done in the rest of the year over last year. Be it in our operational revenue, where it currently is at 3,362 crores as against 6,046 crores of full last year. And if you look at our EBITDA, as against 375 full year, we are already at about 227 crores in the current half year. If you look at our PAT, as against a full year of 174 crores, we are at 117 already in the first half. And if you look at our cash profit, as against 333, we are already at 197 in the half-year stage. So I believe, and our view is that we should do better than what we did last year on a full-year basis. If you look at our return on capital employed, it is increasing, and as more of the assets are getting utilized, this will only further improve better. If you look at our financial ratios in terms of net debt and our gearing, we are still quite cautious. We are looking at only those projects that will help us to give a return. Some of them are strategic, some are taking a little more longer time, but I think overall at a financial level, in spite of all the stress that we have been through, I think we have a very healthy balance sheet in terms of going forward and seizing opportunities as and when we see at a strategic level. Thank you. And now I'll hand it over to our chairman.
Small correction, Suri. I think as a company, we never went through any serious stress. The industry stress. Yeah, the shipping industry went through the stress, but as a company, I think we always maintained a very healthy bottom line, very healthy cash flow, and very low debt equity ratio. So I'm very proud to say that. So just a few clarification on the basis of what my colleagues have said. I just want to make sure and put the DPD in the right perspective. What I want to say is the Indian ports, first of all, are not designed to give delivery of all the containers straight from the port, which the government has adventured, and they realized that this is not going to be possible because that was putting a lot of pressure on the port operation. The ports are there to handle ships. Ports are not there to handle cargo. That is how the ports are designed. Because when the ports were designed, they deliberately kept the entire cargo operation outside the port because they don't want to bring in the labor. The 70% of the labor, 75% of the labor, or maybe more, are engaged in handling the cargo, not handling the ships. The ships handling is all become automation. So they wanted to keep the cargo handling out of the port, and that is how so many CFSs have come up. Now, just by simplifying procedures, every container cannot move from the port. Yes, about 20, 30, 40% of the cargo can move out of the port, but the rest have to come to the CFSs. And anyway, the export cargo always comes into the CFS. They can never go into the port directly. The factory stuff containers goes to the port, and there also there is a system called a buffer yard. So a lot of containers come to the buffer yard, they get offloaded. Buffer yards are within the CFSs. So they get offloaded there, and as and when they're ready, out of charge, then they get moved to the port. So that operation will always going to remain. Of course, it has put some pressure on the margin, which we all know, right? So that margin pressure is there. And as far as our company is concerned, we have a tremendous management capability and a good relationship with the customers, which keeps our volume growing and margins what it is in the market. Nobody gives you additional margin, right? So we have to fight for the margin, and that is how you see our performance has improved in spite of DPD. And we believe it is sustainable. So that's one message I want to give you. The second one is about project and equipment business, which all of us know that has put some pressure on the return on capital. And also some of the land bank, which is sitting in the company's books for a few years, because we could not use that land, which, although they were acquired for developing logistic parks. Because of what happened in India in the last 4 or 5 years, exactly after, as all of you know, that UPA 2 government, subsequent to that, we all know about the story, what the Indian industry has gone through, over leveraging and coal scam, and all that has put tremendous pressure on the economy, and the entire growth engine of India came to, industrial growth in the country almost came to a standstill. No new investments were coming up since the last 5, 6 years, and that is the cycle that the company has gone through. Because of that, the equipments were underutilized, and the project order book had dropped. But we are at a time, we managed almost till 2017 because we were lucky to have very good projects, particularly one in Reliance Jamnagar. They were doing their expansion. A lot of our equipments were used there. The windmill was doing quite well. The cranes were utilized there. And unfortunately, both came to an end right at the same time. The Jamnagar refinery work got completed, and the entire windmill sector went down because of solar prices went down substantially lower than the windmill generation. So that is why the equipment utilization has gone down in the last about 3 quarters or so. And now, like Adarsh has said, that the utilization has already started moving up, and we expect that to improve because the windmill sector is revived, and a lot of new projects are getting implemented. We're not talking about any big projects, multi-billion-dollar projects, but there are medium-sized projects which are getting implemented in the country. That is why we have a order book of 175 crores in our project division, and a confirmed order, a visibility, additional revenue of about 75 crore, where we have a contracts in hand in the equipment business. So I think, with this revival, this division will do well, and this will contribute to a better return on capital in the business. And also, we are moving out of the assets which are not giving us a good return. It's a bad time, so it is difficult to get the value for the asset when you want to sell in a bad time. Obviously, we all know that. And as the markets improve, we will sell some of the equipments and hopefully make better, more money than what is showing in the books as a book value. So the third thing what I want to talk about is about the liquidity of the stock. If you know, Allcargo was not so well known for the liquidity of the stock, because we had almost 95% shares were held by 4 groups. Blackstone, as all of you know, that exited at a rate of a share price of 180 rupees last year. And then we had New Vernon, who was holding about 6% shares, and they also have sold quite a bit of their shares. Now, as we speak, we have a good amount of liquidity in the stock, which I'm sure most of you know. I wanted to talk about that because that was one of the issues that was always posed at us, that we want to buy the stock, but where are the shares? I also want to leave this thought with you that, which I have said earlier too, that we are the first Indian company, not only grown in India, we are grown internationally. And it's a very unique company in that sense. That is not just about we being global, it also protects the company's performance or company's business and profitability, because one sector may not do well, but there is something else supports it. Same way, one country may not do well, but there are many other countries supports you. So that's what exactly has happened to us being global. We have been able to withstand some of the pressure in India by international business, and some of the pressure that international business had in the past, where India came into support. So because of that, we have kept on growing almost every year since we were listed. And the way they operate, obviously, they operate a platform. Their business plan is of a digital freight forwarder. Now, what happens in their case is they don't have offices on the ground. So they employ hundreds of people at their back office. They're not really a company which is automating their process at the back end. And also the fact that they don't have their own network, they need to tie up with somebody or the other, different places and different markets to execute the business that they procure through their platform. So in our case, we have a global network, and we now are ready with a global platform. And with using this platform, we should be, in the future, would be able to acquire businesses electronically, digitally. And since we have operations on the ground, we would be able to efficiently, without adding more people, to execute the business in a more efficient manner. So which means using this platform, we would be able to reach deep and wide in the global transportation and global trade. So we see as one of the big opportunity. And the current effort that we as an organization is putting in within the organization is to make ourselves digital ready. It's good to have a platform, but you need to also have the whole organization, which is a legacy organization, need to support that digital business plan that we will roll out in the future. Also, when you go digital, you need to also offer value-added services. Now, value-added services are, today, most of our shipments go from port to port and port to a CFS and port to another final destination, for example. But we don't do door-to-door. So as you go digital, that's the opportunity for us to pick up the cargo from the origin and deliver it at the final destination. That's an opportunity that will emerge as we get into our digital business plan, and the company is already working on having our own tariff for that in place. As you see, we have quite a reasonably strong balance sheet, and I think the industry, as digitalization is becoming more and more popular in our industry, and as in when margins in the business comes under pressure, many of the companies are forced to look at exit or, mostly exit. Yeah. So, we are in a good position to make use of such opportunities because of a good balance sheet, and also the fact that we have the experience of acquisitions and integration of the acquired company and create value out of it. We have a proven track record of that. Our strategy on acquiring majority stake in ACCI, that is Avashya CCI, has been very beneficial. It happened at the right time. If you look at some of the valuations of Mahindra Logistics, and few of those companies are far, far better than what the value. I think this business is not even valued within our company today. The reason I'm saying why it is a very good acquisition, first of all, it has been done just before the just before the rollout of GST, and it also happened as the e-commerce business is growing at 35-50% CAGR year on year. Now, and because of this acquisition, we are also in the middle of the revolution that is happening in the logistic park business, where large box of warehouses are required. As you know, that one of the reasons why the company's return on capital is lower is because we have a big land bank of close to about 350 acres of land, which is unused. They're very strategic, they're very well located, most ideal for building logistic parks. And as we speak, we have signed number of deals with large organizations who need these warehouses, and many places the construction have already started. So Jhajjar, for example, I think will consume the whole place within the next 2 years. Same in Bangalore. So there is a big opportunity out there. And all this happened because we are in the middle of contract logistics business, supply chain business, which has given us the visibility of this opportunity. You also know that there is a substantial amount of funds are interested in investing in logistic parks, including the CPIB, the pension funds, and a lot of other overseas funds are interested in putting their money into these ventures. And at some stage, one could also look at selling some of the projects if it makes sense. As all of you know, that we are also in the middle of the revolutionary growth by our Honorable Prime Minister's leadership. A lot of development happening in the infrastructure. A lot of new things have been introduced in terms of bringing the overall ease of doing business. Index has gone up quite substantially. All of you know about it. I think we are in the middle of a very exciting time. Yeah, I think that's pretty much what I want to leave the thought with you. And I really want to take this opportunity to thank the organizers, and always very, very thankful to our team, who work dedicatedly, almost sometimes round the clock basis. And all this achievement wouldn't have been possible with their valued support. And obviously, we are very grateful to our shareholders for their confidence and support and helping us to grow in the business. And we'll always be very, very mindful of that. We are a company very strongly believe in value creation. We are a company who very strongly believe in corporate governance. And we are also a company who believes a lot in giving back to the society. And this organization stands for a purpose other than just making profit. We have several initiatives that has been rolled out. We spend much more than the CSR mandate that the government has given in our quest for giving back to the society. And we are also very happy to say, you have seen in our video, that we believe in the green contribution to the nature, and we have banned all plastic items into our office properties all over the country, and we want to take it forward all over the world. And I was very saddened to see yesterday one of the whale picture which died consuming 8 kilos of plastics. So that goes to show how bad our ocean have been polluted. I think each one of you and each one of us need to do our little bit to contribute to avoid as much pollution as possible, so that we leave a better world for our children and the grandchildren. So Allcargo very strongly believes in that, and it not only practices it, we also influence our employees, influence our stakeholders to spread the message, because the miles of 1,000 kilometers is done with the first step. And I think I would definitely encourage each one of you to also do your bit to spread this message and do your best towards this. And thank you very much, and we now open the floor for questions.
Thank you, sir. Yeah, hi. Thank you, sir. And thank you, gentlemen, for the very insightful presentation. We'll open the floor for questions. If you have a question, just put up your hand. Two tall gentlemen walking around the mic.
Sir, first and foremost, many congratulations on completing 25 years. This 25-year story, which you have very
Thank you very much.
You have very well encapsulated in your audio video, says everything about your incisive, in-depth initiative and innovation to bring the organization to a global level, and you have a master sitting next to you. So it's full marks to your vision, to your enterprise, and to your perspiration.
Thank you very much once again. Thank you.
Just two questions. You obviously have touched a lot of answers on the questions which you have anticipated in our mind. You referred to 350 acres of land which you are having for logistics park, which has not been utilized, and now with private equity and investors showing interest in putting money in these logistics parks, both at Jajar and Bangalore, what approximately would be the unlocking of the capital in case these get placed with these investors?
Okay, we can, obviously don't want to make forward-looking statements and, mislead any of you.
No, I'm
things.
not asking.
No, I understand.
You can give us a conservative estimate.
Sure.
Whatever you have in mind, minus 25%.
Okay.
Because that will give us a sense of the incremental ROCE.
Yeah.
It may happen in 3 months, it may happen in 6 months, it may happen in 12 months.
Yeah.
That's okay. But that was the one point which struck a bell of alarm.
Sure.
That money which is lying in an asset which is lying unutilized.
Yes.
So, if you can.
Yeah. So, I would say this, that we had made a press announcement that we'll spend about 1,000 crore in the logistic park business. That was said about 6 months ago, I think. Now, in this 350 acres, we can build close to about anywhere between 5 to 6 million square feet of warehouses. And it will have a construction cost of roughly about 1,500, 1,600 rupees a square feet. And all these warehouses we will develop on the basis of build to suit against a contract. There is no speculation here. Okay. So, and all these business warehouses will be leased on a long-term basis to very marquee customers. And the market rent is roughly about somewhere in the region of about anywhere between 16 rupees to 20 rupees. It depends on the basis of what kind of a specification those particular customers would like to have. All I can tell you is there is a big demand, and we are very well positioned. Land acquisition in India, as you know, is a major effort and time consuming. So there are quite a bit of people who are interested in that. So it's a good opportunity for the company. And also the fact that I mentioned about the synergy, why we believe that acquisition of ACCI was at the right time, is not only because we came to know, it slipped my mind to tell you, came to know that there is going to be such a big opportunity in the warehousing sector. It is also the fact that we ourselves would need a lot of warehouses for our customers. And we do the internal handling of the warehouse. It's an asset-light model. We rent warehouses from third party. And today, one of the main driver to get the business is owning such warehouses. So we are in a little bit of a conundrum whether we want to build everything for third party or want to build some for ourselves and use that for our customers. So I think a combination of that will happen eventually. And since we have the expertise now developed within the organization to buy land, to build, have the capability inside the company to also make sure that we get the right quality within time. The entire project management team is there in the company, and we have those capabilities already in the company. So we see very small risk in this model. So that's, if that answers your question.
Yeah, you have very adequately addressed the question. Thank you and all the best.
This is Giriraj here from KM Bisare Family Trust. I'll have 3 questions on each of the segment. So I'll start with first MTO segment. What we are seeing in the market, what are the rates available to us, that container rates are going up. So from April onwards to now, they have moved up by somewhere about 30-40%, if I have to say. So are you mentioned that rates are not moving that significantly, they're just more or less steady. So what is your sense that had the rates moving up? And the second thought is that what is the demand supply you are looking in the container market? Is the demand growth expected to be higher than the supply growth, including the scrappage, adjusting for the scrappage part, so that the container rates can move up over the next 2-3 years?
So, to address your last question first, I mean, you know, there are analysts who do this kind of projections, right? Because it's very difficult to know what's happening. They are tracking the growth of the container fleet, they are tracking the growth of world trade. And what they tell us is that for the foreseeable future, the overcapacity which is in the market and has been in the market for quite a while is continuing to exist. Yeah, so that's the first answer. You know, there's very little indicating that trend will change. It would require a significant growth beyond expectations of trade, or then a significant impact from the scrapping of older vessels. And you know, if you look at the vessel age, an old vessel, you can consider a vessel beyond 20 years, and the fleet size of this part of the fleet, global fleet, is relatively insignificant, I would say. So then comes the question of what I've mentioned, the low sulfur regulation, right? We don't know exactly what's going to happen, but it could be that especially smaller carriers who are not so capital strong have a problem to upgrade their vessel and will be put into a difficult position also by the increasing costs. That can lead to further consolidation, can lead to bankruptcy. But definitely the bigger carriers will be well equipped to cope with that, that trend. So the growth of the rates and the rate levels. Let me first say that, you know, we are actually benefiting from higher rates, which may be counterintuitive sound counterintuitive to you, but our margin, the lower the rate, the more difficult it is to get a premium, a margin on the freight, right? So we have been well able to cope with the current rate levels and the low rate levels, historically low rate levels. So we are able to deal with that. But if the rate should indeed go up, and this is always trade specific. It's very seldom that globally just the rate go up just like that, right? So should the rates go up, we will benefit from it, right? It's very difficult to predict. We had a surge in trans-Pacific trade in the last couple of months because US companies were stocking up into inventory because of the threat of the higher tariffs, right? We expect that this surge is going to diminish now that we are nearing the end of the year because the inventories are already full, right? So we will probably see the rates coming down again. On the other side, we have consolidation in the industry. You would expect that the carriers would be able to better control a healthy market rate if there are less carriers. So far, this has not really happened, unfortunately, let me say that. But again, we are very well able to cope with any kind of development in the market. That's one of our core capabilities, I would say, to deal with that. Because, there's always a lot of volatility, not only in stock prices, which is your business. There's also a lot of volatility, usually in our business on the rate side. So that's one of our core, strengths is to deal with that. Excuse me?
What kind of ore capacity is there in the market right now?
Yeah, it's still significant, up to 25%.
Okay. My second question is on the warehousing segment. So, first of all, what was...
Adarsh, you want to add something?
Yeah. Actually, straight coming to the point of where demand and supply. Today, the supply is more than the demand, if I had to put it straightforward.
No, I know, but
rightly got it 25%.
Like most of the bulk and the tanker index are talking about that by 1920, the scrappage will pick up and the supply addition is low. Correct. So they expect the market to recover.
Yeah.
So is that what we are also expecting? That was the idea to ask.
Absolutely, absolutely in the container business. So 25 to 30% is what we still have that, I would say, underutilization part of it. Okay. While you look at it on the other side, the yards, because that's the measure that we get. Today there are no new orders for the yards, right? So people are not looking at it. So that's an indication. If the demand and supply would have squeezed the other way, people would have gone and ordered, because a vessel doesn't come over in 6 months. You have to order it. We at least don't see this happening for the next at least 2 years. With the sulfur, what like my colleague Claudio said, that could probably force some of them to probably, as we said, it could, smaller vessels could get scrapped, but that will not make a big impact. We still have room for, there are already big vessels in place.
Okay. My second...
one or two points in addition to that. See, the shipbuilding industry is also driven a lot by the countries who want to promote shipbuilding and ship repair. That is China, Korea, Japan, right? Their steel industry, their labor market gets highly impacted if ships don't get built. So in that sense, there is always that element which you have to keep in mind, because they can give a lot of subsidies and still keep the industry going, etc. That is one point. The second point for our business, the ocean freight part in our whole procurement is not more than 40%. Most of our cost on the land side, and the recovery is also on the land side. So land side recovery is higher, substantially higher than the ocean freight. So ocean freight goes up and down. It does impact, of course. We always like a better ocean freight because we can make a better margin. But if it goes down very low, we have other impact, because a lot of cargo can get converted into LCL can get converted to FCL and get shipped out. Because if LCL cost, absolute terms, it's higher than transporting FCL, right?
Understood.
So we like the ocean freight to be always higher as a company.
No, understood.
Anyway, next.
So my second part was on the warehousing side of it. So first of all, you gave the number of 1,500 crore construction cost, had I heard correctly, on a 5 to 6 million square feet?
Yes.
But isn't that the number high? Look at 2,500 to 3,000 rupees per square feet kind of cost we are talking?
Warehouse construction cost is 15 to 1,600 rupees a square feet.
But
because these are boxes.
No, but we are talking 2,500 to 3,000. If I do the math, so from 1,500 crore of construction capex.
No. 1,500 rupees a square feet
Square
is the
feet.
cost of construction.
Understood. So that
That's
was
what I meant. Not
I heard
1,500 crore.
I heard that
Yeah,
was the.
yeah.
So what was the revenue of warehousing 3.5 million ton in the first half? 3.5 million square feet in the first half.
No. The logistic park business will be a separate business where we will construct and use our existing land bank and lease out that land to, say, for example, an Amazon.
Correct.
Right, for example, right? But the internal utilization of the warehouse is also need a contract logistics or supply chain management company to manage it for them. So that is our Avashya CCI. So Avashya CCI will get the benefit in some cases to also do our warehouse management within the warehouse, which we lease for different business altogether. So that is the additional, that's the synergy we are talking about.
No, I know Avashya CCI is a 62% owned JV, and that has a 3.5 million square feet.
That
right?
is a leased. Everything is leased.
So what was the revenue of that? I'm looking on that number.
No, but that is, we don't charge, the revenue of that company is 150 crore per year, right?
But that include logistic also.
Huh?
That include logistic also.
No logistics. It's only warehouse management. It's a roughly about 32% GP margin business.
Okay. My last question is on the CFS side of it.
Yes.
So you mentioned about the DBT making it mandatory that they have to come through the, let's say, CFS. What is the EBITDA per ton difference? Let's say, assuming the same dwell time, maybe 4 days or 5 days, what is going to be the EBITDA per ton difference between a DBT CFS coming through or normal CFS coming through?
Yeah, approximately 10% would be the difference between a DPD box and an en bloc box or a third party box. So today we have different segments of customers. So we have a DPD, which is a pure DPD guy, DPD CFS, third party. We got en bloc, which is the traditional model, the earlier model. So we are able to give services to all of them. And that's why we have grown, because we have gone into all the segments. We have not ignored anyone, because that's what is going to remain. But with the new announcement from the secretary to the shipping ministry, he has come out and said that we will want all the boxes to go to the CFS, even though you are a pure DPD. Because I would like, that's what they're saying, they would like to remove the congestion, not only inside the port, but also outside the port. Because all the trucks are lining up and they are creating the chaos. So they want to remove all that and distribute it into the number of CFSs which are around the port. So that's what is the future model.
Okay, understood. Thanks a lot.
In MTO business, what was the growth in LCL containers and FCL containers in first half? And what is normal breakup in terms of percentage volume? How much is we are doing currently in full container load in MTO?
These are all a little bit commercially sensitive, so generally we don't give in these breakups because at the end of the day we are competing with people who don't publish these statistics, and the more we publish, it'll become, it's a counterproductive impact for us. So that's the main reason why we would not give, but at an average level, I think in a growth terms, that's why we are giving you at a growth terms level, I think we would be in a position to grow at this volume of between 20 to 25% on an year-on-year basis, on all of the.
Yeah, and one more question. You also mentioned in presentation that a lot of shipping companies are also entering into land logistic or end-to-end solution. So how big that development happening, and how do that could impact players like us in going forward?
Yeah, so as I said, from our point of view, what we are looking at is to provide value to the customers, and to expand into that business for us is an ambition, right? And we are working on the tools to be able to do that. We have upgraded the capabilities of the organization, so that is definitely an important part of our diversification from CFS to CFS to door, right? Of course, carriers like Maersk have recently insourced again their supply chain and forwarding arm. So other people are also looking to provide that same value to customers. It's very difficult to say whether or not one or the other initiative is going to be successful. You know, especially on the carrier side, we have seen carriers going down that road in the past and later on pulling out of it again because their core business indeed is the liner business. So we are not at all concerned about that. You also have to keep in mind that the market, the logistics market, is indeed huge, right? So we believe that the opportunities for us, with our existing customer base, with our digital tools, with our end-to-end capabilities, are far more bigger than the risks we face from those developments, which have always happened and will always happen in the future.
Let me add to that question of yours, that is, what does it do to us if the shipping lines would like to do it, that is, go into the last mile? In fact, they're looking for partners like us. They want somebody who's already established to help them out in delivering that. So it is an extension that they want, and they find that in us. So yeah, it's an advantage for us, for our growth, for our future.
And last question, in end-to-end logistic, what we are really looking is like as a additional service to the customer, or it is like full-fledged focus on a business where we really want to scale that up, and it will really increase our complexity in terms of pricing and risk in terms of pricing, because of a lot of levers will be get added. So how will you manage that aspects, or will it change margin profile significantly going ahead?
This is the need of the hour, because this will create a lot of stickiness with the customers. That's the first part of it. Second, we are in a better position because we are already in some of the countries, if you look at it, we have already built our infrastructure in providing the last mile and the first mile. If you talk about in US, we do provide, of course, on an asset-light model, where in India, we do have a mix of both, so we have that as well. Few of the other countries also, we're trying to put in those, last mile and first mile, how we can bring in other partnership where we can actually provide that services. This is going to be the future, because now today, just being on a pure freight business, you're not going to survive, because people need value-added services. People are asking for it. So they say that, okay, just deliver it at my place. So we're getting ourselves as well geared, and I think we are in a much better position than anybody else. As like Prakash said, a lot of shipping companies are already talking to us. I can be vocal about it, and they are already asking us that, can you provide us the services? Do I say this? And why not? If that shipping company comes on board, it's like creating a stickiness with that customer. Then he is also dependent on our services, right? That's what I would say. Did I answer that?
Thank you.
Shashi sir, just want your vision for the company for next 5 years, considering whatever things we are doing right now on the space. Where do you see Allcargo in next 5 years? And if you can quote some numbers in terms of your revenue vision or a PAT vision or ROCs, if you can just share that.
If you see, our growth has been both organic and inorganic, right? And we continue to believe in that, and we continue to work towards that. And we like to make one thing very clear and very sure always, is to make sure that we create value out of the organic and inorganic growth. Sometimes we get into certain business, but we realize very quickly, then we try and take corrective steps how to avoid getting more deeper and deeper into such businesses. So these are part of the game, and we are a very easygoing organization. And I think in terms of if you take a pure organic growth, we don't have a reservation that we will not be able to achieve a growth of about 15% year on year, although it's a very high base. But inorganic is something I can't comment, obviously, because all depends on about the target and what's the price and what's strategic, synergetic that model can be, etc., etc. And that's why I'm not able to give you a number per se. But the philosophy of the company, I can tell you this is the philosophy of the company, and it will remain how it is. And we have a stated objective to achieve a $2 billion revenue company. But, you know, this is stated objective, right? I mean, this is no way a forward-looking statement, so don't get me on that at all. So this is something we aspire to achieve, and I don't want to put a bottom line target number to that. So that may be very sticky one. So that's to just give you a flavor of our aspiration.
Sure, sir. And on the project and engineering division, we have seen some hard times. Now possibly we have seen the bottom of it. At best, what kind of margins and ROCs has this segment seen? And at this juncture, are we saying that probably we would see strong growth ahead, because capex cycle as such has not yet picked up in India? Considering elections coming through, we do not see that happening until the elections are out. As you were saying on the taxation side, the companies might want to wait out till the elections are off as well. So, although the wind might have seen some amount of growth, what is our outlook on P&E segment, and at what level does it break even, considering the base that we have created after corrections? If you all can give some insights on that.
I think on the project and equipment, the equipment business in particular, the bottom, what we have seen is in the last 2 or 3 quarters, which is very unprecedented, which has never happened in the last 7 years when we started scaling up. So I think that's an aberration. Other than that, I think the company has done, the division has done reasonably well. I think we have a return of about 15%. If you ignore the last 3 quarters, our return has been 15%, which I think is not bad. And also, like I said, in our presentation, we mentioned that the market value of the asset is much more than the book value, because you depreciate significantly while the equipment doesn't get depreciated. The main reason being these equipments are always, the price always keeps going up. So it is not like a truck where, or a car, like where the depreciation is real. So that is why we are able to sell even in a bad market at value which is much higher than the book value. So that's where I think we stand in that business, and I think it is in the uptick, and it will reach the levels of good levels what we have seen in the past once the capex cycle improves. My view is that, as I said earlier also, that the manufacturing in India will pick up in the very near future because of the reasons I told you, that even a lot of Chinese companies, as the consumption of India increases, more and more things will have to be manufactured in India. Not only because the government will mandate it, it's easier to also, and cheaper, to manufacture in India instead of importing and then selling. So you see the investment announcements by the electronics companies, the defense companies, many of the Chinese companies who, if they get imposition of tariff by the US, why not they also shift to India? And what I heard today, a lot of investment commitments have been made in the Maharashtra, in Aurangabad area, for a lot of the Chinese companies, and in many parts of the other states in the country. So I think manufacturing has a good future, and with the focus of the government to where the exchange rate is, I think it is great to export, getting the benefit out of the currency situation. And I think India as a country, has a greater potential to export than what we've been able to do. We didn't do a great job, and I hope going forward, and I hope the election will bring a better result also for the country, so that the policy continues, the ease of doing business index keep dropping. I think we're all very optimistic. If you ask me, very, very optimistic about India. There will always be aberration. India is always 2 steps forward, 1 or half a step backwards. So that, because we're paying the price for the democracy. So I think that's quite a fair way to assess, I think. Yeah.
I probably would have missed it earlier. You would have said, so if you can lay out your capex plans for the next 2 to 3 years, and especially on the logistics park side, and the revenue visibility that you have from the same, when do you expect sort of capex turning into revenues, and So if you can give some sort of a timeline and lay a roadmap for the same. Thanks.
Our main capex, as I told you, is going to be in the logistic park development of the existing land. And strategically, we may acquire some land for our requirement and as opportunity unfolds, right? So that is one investment. You can say roughly over the next 2 to 3 years is roughly in the region of about 1,000 crore, purely on developing logistic parks. Our other capex plan is incremental. There is no big investment capex that we are expecting. And lastly, some of the capex can happen if there is good acquisition opportunities come around. So that I can't give you a number because I don't know myself. So, pretty much that's what I about, yeah.
And the return potential on this 1,000 crores, and when do you feel the revenue actually materializing out of the capex that you'd be incurring over the next 3 years?
Yeah, the revenue will start getting generated over the next 9 months or so.
So basically, one should equally distribute.
It will start from 9 months onwards. Let's put it that way. So because the work construction is going on in some places. So once they get completed, they leased out, then the revenue will start getting generated, and that will continue till we finish all the projects. That will take roughly about 2 years.
And there is no plan yet as to sort of divest this to other partners or getting a private equity in, because we were thinking along those lines to sort of restrict the asset ownership and asset heaviness of the model.
Yeah, we have those opportunities. We don't want to talk about it now, but we definitely have those opportunities to improve our ROCE.
Okay, thanks.
You spoke about your digital investments that you're making in a platform. You also spoke about Flexport. How is this more, detailing of information to the customer, is that making business more difficult? Is that potentially hurting margins? I'm just thinking about, as ticketing in airlines business, for example, became more democratized, the agency business moved out and people are now booking on digital platforms themselves. So will that become a cause for concern for the MTO business in the next 3 to 4 years?
I think the transparency is already very much existing today, to be honest. What I think is that the visibility, of course, will improve because, systems will be more integrated and there's going to be more platforms. So the visibility will be even improved. Digital will also allow to save costs, so increase productivity, right? So obviously the margin erosion should be compensated through that. That's our ambition and our expectation. On the other hand, if you look at those platforms, somebody needs to carry the freight. As the chairman rightfully said, people like Flexport, they are working with us. They don't have their own capabilities on the LCL side, for example. So they need people to do the actual handling with them, right? And these people, they need to be digitally enabled, because if the front end is only digital and the back end is not digital, then there's no value in the market, right? So they're looking for partners who are able to cope with their ambitions to become, a digital freight forwarder, a digital platform. So I think we will see new entrants in the market, which are coming from that side. We will see certain legacy companies maybe disappear, maybe a consolidation in the market. Our ambition is to take very strong effort and focus in taking advantage from all those developments, yeah, and being able to control the capacity, having the know-how. It sounds easy, digital freight forwarding, but it's actually quite complex, because if you look at how many partners are involved in a supply chain, it's not so easy to digitalize that. And you need a strong know-how, a local market expertise also. You need to be able to cope with changes from a legislation point of view. So what sounds very easy is actually quite complex. So you will still require the specialists, the know-how on site in the country to a certain extent, not to the extent we have it today, who has that capability. And those people, usually they don't have it, right? Why is Flexport now starting to build warehouses or to rent warehouses in Hong Kong, for example, in Asia, right? Because they see that just with digital alone, it's very hard to compete. Amazon themselves going into logistics, right? Because just as a platform is very difficult to compete. So we will see a lot of change in the marketplace, but for us, you know, with all the initiatives which we have, we believe we are very well positioned. Yeah?
Yeah. So just two simple things, right, to add to, because you mentioned about passenger booking a ticket. So two things here fundamentally different is one, cargo cannot talk, cargo cannot walk, right? So it always needs handling. It always needs somebody to plan and, you know, move and things like that. And the second thing is for cargo, there are a lot of regulations get implemented, attached. And the third factor is there is security. You know, so these are the three factors which will always make sure that you need to have foot on the ground. So for a company like ours, who already have a foot on the ground, if we are able to digitize our entire operation and integrate that with our current organization, you know, that is a winning combination. That's is our strategy.
This platform is going to get rolled out middle of next year, right?
It's already rolled out. Okay. If you can visit our website, you will find something called EQ360. That is a brand of our platform. And using that platform, you can already book the cargo. You can trace your cargo. You can know the sailing schedules, so you can plan your entire booking for the future. And you can, now we are in the process of adding the payment facility to that. So then typically it is almost there. Yeah, and it's integrated to our ERP.
Okay. Yeah. ERP, which you, I think your question was referring to my statement about the rollout, which will conclude next year, right? So that is our ERP. That's our internal operating platform, right? And already now we have close to 80% of the global volumes on that ERP. So there is now a last step to take, which will then obviously be adding up to the efficiency gains which you can achieve in the operation.
And how much did you spend on this technology platform? How long did it take? And is this something which is custom built for you, or is it something which is available on the cloud that other people can use as well?
No, this was all designed by us. It didn't cost us much. And then it took us about a year to develop it. But at the back end, we had to do a lot of changes, but otherwise it's rolled out. And in fact, as Claudio said, in 40 of our countries now, the ERP is running. 2 of our major markets, that's where in the first quarter and the second quarter of next year is where we are hoping to install that. So when that happens, then the full integration is on, and then it's on to a much more wider market.
So the ERP took us about 5 years to develop, and 5 years from development to roll out to 60% of the countries where we are operating. The balance 40% will be rolled out very quickly in the next 2 to 3 quarters. And the platform, like Suri said, didn't take us too much of time and didn't cost us too much of money, because it has been done a lot with having the knowledge internally, and you know, a lot of ideas which went from us, and is developed by some very good vendors who are known to us. Of course, we'll have to keep upgrading it, and you know, that expense will be there.
So as a follow-on to what Ashwini was asking, you know, you can have 2 purposes for this kind of a digital interface and all the integration that you are attempting to do. One is to forestall any fall in your revenue, because the competition is coming out with an alternative model, and why not, you know, you prepare yourself and you protect your volumes. And the other approach, and both these approaches can be, you know, happening concurrently, is to further increase, you know, your share of wallet or actually cause some kind of a consolidation, which somebody is operating, like the Flexport example you gave, is coming at it from one angle, and you adopt the best of that and become a better competitor. As such, whatever Flexport is trying to do, you can do better and faster. So which of these two or both is likely to happen?
I think we are trying to do both. Like I said earlier, that we want to penetrate deeper and wider in the marketplace. That's one of the reason why I think digital platforms are, in any case, are capable to do. And what was the other question?
So would it help you, increase your share of wallet, increase the margins? So is it more defensive or offensive?
No, it is definitely a strategic thing, not just to improve our current performance. It is done with the idea of how we can expand globally by not only reducing the cost of conversion of the business. The cost of conversion generally is approximated around 12 to 15% on having the sales force and sales management, etc., etc. So that can be brought down substantially if it is done correctly. So that is one strategy, definitely. And the second strategy is how to get customer stickiness, and how do we reach out to potentially new clients. Because our market share is globally, if you look at it, it is still very small in LCL and FCL. So by having these tools, this business plan, I will not call it tool, so having this business plan, we would be able to reach out to a much larger customer base.
So I had a different question. In terms of, you alluded to some of your competitors in India, and also, one of the Silicon Valley company being valued very highly. One of the features for these businesses to be valued highly is return on capital. Most of these, businesses try to leverage the existing infrastructure which is already there, and then combine it in an innovative manner, such that, a more than fair share of value accrues to them, while they don't spend so much. However, for the past few years, you have been having certain businesses which are very high, return generating, and there are a few which perhaps are not so, value or ROC generating. So would it make sense, considering that you have a capex plan ahead of you, and I do realize that you have a very steady cash flow. One of the, defining features of Allcargo is that no matter what the situation is on the ground in India, you have managed over the past many years to deliver, steady and strong cash flow. That being said, wouldn't it make sense to, divide the businesses into the capital intensive and the non-capital intensive, such that both can pursue their own plans and some value unlocking can happen as a result?
Yeah, it's a very good suggestion, and very well appreciated. And these thoughts are in our mind, and obviously we're working on the right timing and whether we should do it, should we do it, when we should do it. So this is a very, very, very valid point you made. Yeah, the board has been evaluating about it for a while.
Actually, I had a follow-up question on MTO business. We are known for LCL. We have got into FCL. Do you estimate in a period of 3 to 5 years, can LCL and FCL contribute to the same on the top line?
Yeah, I think from a tap. So is your question about the growth potential of both individually, or what? Yeah.
At the top line, can it be 50-50, or MTO will still be larger than FCL?
It can be 50-50, but it will take a little bit more time, right?
Yes.
Because I think that could be an ambitious goal, 3 years.
Okay.
Yeah, I think our volume-wise, our LCL business is still, from a revenue point of view, much larger than the FCL business. But having said that, as we alluded to various times, we're also looking to acquire companies. And based on the opportunities which exist either in LCL or in FCL, that may of course then change going forward. What is important for us is to generate value through growth. We don't want to grow for the sake of growing our top line only, right? We want to generate value. And of course, some of the top line growth is helping us to achieve better productivity, better buying rates, but still we need to be able to generate a healthy return. The FCL business return on average is a little bit lower than the LCL business return. Yeah? So we need to be conscious about that and take the right steps to grow our FCL business. We have been very successful with that in the past, and we want to have the same approach going forward.
Customer base for both are different. LCL and FCL will have a separate set of customers.
No, not necessarily. There are. No, I think he summed it up well. I guess yes. If you talk about the revenue today, the LCL is far away from the FCL because we have enough of room to grow. Our percentage in terms of our market share in the FCL is very minuscule. So that's one of the reasons that we have opportunity to grow. While to get to there in about 3 years' time, yeah, maybe it'd be a little difficult because even at the same time the LCL will also grow, but the LCL's revenue model is very different than the FCL. It's just the freight part of it, right?
Do you see India estimates supporting the FCL much more than the globe business?
Yes, as of now, that's how it looks like, and going forward, we will play globally as well.
As you're answering most of the questions right now, let me come to your division, PE division. You all executed well in Jamnagar, as Sashi said. Do you see any visibility in so-called project on paper today from Maharashtra, the Saudi Aramco and IOC HPBP joint venture? Any indication about sourcing any equipment from you, or it's only on paper?
As of now, we have not seen some traction on it, so it'll be unfair on my part to say.
Okay.
But I guess, yeah, except for the windmill project.
No, that's fine. I'm talking about.
He's only talking about Maharashtra.
Maharashtra refinery.
IOC refinery.
Any indication from HP in Rajasthan?
Yes, we have some inquiries around.
Okay, and what about the so-called newspaper item today, 30 million in Jamnagar?
That's the news which we got about a week back, and we were very happy about it. So I'm sure we will have some opportunities there.
Okay. The next question was on your logistic part. Let's assume that you're spending 1,000 crores on construction, and you have 3.5 million going to 10 million over a period of time. And you're still debating how much will be used by your captive customers and how much will you contract between Amazon and others. Are you trade off 50-50, or what's your thinking plan there? Because return on both will be different. I suppose your value-added customers will pay you more than Amazon.
You know, I think what we'll do is we'll do some short-term contracts with a small portion of our own warehouses for our in-house requirement, and large portion I think we'll sign for third-party customers to keep it because that is definitive, right? And we don't want to take too big a risk of for some reason something going wrong and end up with a big liability. So we would a significant portion we will lease out on long-term basis, and some percentage we'll keep it for ourselves. And anyway, like I said, few strategic places we will continue to develop, purchase some land, and you know, as that happens, as the visibility for supply chain business increases, then obviously we'll reserve it for that.
Are you sensing any port operator company giving you end-to-end solution in India?
Very difficult, long way off.
Long way off.
Yeah.
Okay, and my last question, thanks to the trade war between China and US, are you getting, because a lot of agri and some of the other exports from India where we have CFSs, most of the commodities can't be exported in containers, but Are we getting some kind of business visibility between India and China, which may be one-off for next 1 year or maybe for 3 months? We don't know until G20 is over. Are you getting any benefit or likely to get any benefit?
I think some of the products which America buys from China, I think that market could shift to India. I mean, China buys from America.
So China is likely to open soybean, rapeseed, Iran is
almonds,
whatever products from India. Are you sensing at your container freight station or any related service for pickup and drop, end-to-end solution from the Chinese buyers and exports?
Yes. If I had to put it straight, yes, we have already started getting inquiries for soybean, especially you picked that, and that's one big market. I wouldn't say that how many, it may be for 6 months or a year, but there are a lot of commodities that is going to move towards China. That's our sense as well.
Thanks a lot. All the best.
Hello. So just following up, apart from the 1,000 crore of capex for the logistics park, any other significant capex that we have?
No, I already mentioned that we have no other capex plan, rather other than the regular capex, maintenance capex.
How much would that be?
That would be less than 50 crore a year.
And this 1,000 crores will be spread out for the next 2-3 years?
No, less 3 years, 2 to 3 years.
Sure, yeah, that's thank you.
And by the way, corn must be one. Sushil, to answer your question, corn, that could be a big demand as well, right? Going from India.
Hi. So the last time we met, we discussed value unlocking and monetization. So I have a question around that. One is the land bank monetization of that. The impression I had got when we met was that it's in the near term that you're considering now that you've talked about Bangalore and Jharkhand. Do you see that will you start the process of unlocking value of the land since you've invested on that? How close are you to that? Because you have a long-term strategy which is very clear and you're very articulate about the long-term strategy of all your businesses. But in the near term, how are you looking at sort of creating value? That's my first question. Second is, you've also talked about the global listing because you're not getting the kind of valuations given the scale of business, the spread geographically that you've got, the global footprint. That would sort of be an interesting play as well if you're looking at a global listing. And so one is the land monetization part of it. That's a key piece. If you could give some granularity on sort of milestones that you are looking at the end of this fiscal and the next fiscal, so that gives some kind of clarity and support to investors' confidence. And the third and the final one is the acquisition. So any progress with Gati, or that's out of your radar?
Thank you for asking the question, Malini. About the land monetization, I think, like I said earlier also that, we believe in take money when it's available, right? I think that is always better. There is good demand. So, let us see how it goes. I don't want to, definitely it's an opportunity, let's put it that way. And what?
Are you not keen on doing it in the next 1 year, or you're saying that once everything, you bought all the facilities in place, you have people, who are interested with me, an Amazon or Flipkart or whoever have you, and once that is there, then you will look at monetizing it, is what I'm trying to
No, the option available is you can do the transaction even while you're under construction, right? That can also be done. We can do it at the end of the contract, end of the construction period also. We could do even earlier. Obviously, the earlier ones we rejected because it doesn't make sense. We want to make sure that we get the best value out of the if at all we do it. So I can't unfortunately give you details right now, but definitely something that we are open to. And the second question is about our overseas listing. Yes, definitely. If you compare our multiples for peers. Not exactly. There's no peers exactly like us traded in the in the Swiss Stock Exchange or NYSE or whatever, or Hong Kong or Singapore. They are traded. Logistics company traded far differently than how we are traded at this point in time. Is definitely another possibility, but for that we need to have greater scale, what we feel. And I think that the best way to do it in our mind is if we have a large M&A opportunity where it needs funding, and we get in an investor, and or we can bring the acquired party together and go and list. So these are the discussions happens again and again, but we need to have a good opportunity to have that as an opportunity, and or wait till we build a scale which the global investor would appreciate. And the last one is about Gati. No, Gati is out of the table for us. So.
Unfortunately, we've run out of time. Thank you, everybody, for participating. I welcome everybody outside for high tea, and you can meet the management outside as well. Thanks.